Midstream energy update. I'm in South Carolina on a long-planned trip across the Southeast to see clients, and it's actually turned out to be a great time to be doing that because the sector's been weak. Some of the natural gas names have been especially weak, and great opportunity to talk to people about that and having some really good conversations. And long-time investors, more often than not, pretty intrigued about the opportunity and considering adding money to the sector. So Fort Mill, South Carolina, my first time here, very pretty place. LPL is based here. We have a lot of clients at LPL, and so it's good to see them here. So it's going well. So let me just get this stuff out of the way. This presentation includes forward-looking statements and opinions that, while based on facts we believe to be true, may turn out to be wrong. So you've been warned. If you want to ask a question, you should see a chat box, assuming that you're on the, dialed in on the website. Otherwise, just send me an email. My email is there, sl@sl-advisor.com, and we'll endeavor to get through all of those. So it's really important to keep your eye on the ball here, because natural gas is the key to electricity generation in the United States. Our business is invested consistent with that, and natural gas is seeing and is going to continue to see substantial demand growth to provide electricity for two things, for data centers and for LNG exports. And it's 43% of our electricity generation. So one of the highest percentages in the world. It's actually how mostly how we've reduced emissions in the United States, is switching from coal to gas, and that's going to continue to grow. And this is a chart I put together a while ago. I love this chart because we don't really talk about the energy transition and the threat from renewables anymore. I think people have sort of seen how bad the returns have been on renewables, but the only energy transition that's been taking place in the United States has been the transition to natural gas. And you can just see that green sliver there. That's the increase in energy production from renewables. And natural gas, the blue part, has increased its energy output. The amount of energy we produce from gas has been growing at 8 times as big as renewables over virtually any time period you want to look at over the last 25 years. And that's the energy transition that we're focused on, and that's where we're invested, and that's how we've been generating the returns that we're generating over the last several years. This chart is from the Wall Street Journal today. And if you look on the right there, electricity production and therefore consumption in America has been really stable around that 4,000 terawatt hours or so a year for a long time, at least 15 years. And it's now starting to go up, and it's going up because of data centers. And you see that's the total energy produced. Look at peak demand on the left there, looking to really increase sharply. And that is data centers, and data centers are primarily going to run on gas because gas is available. It's fairly quick to set up. Renewables are hopeless. There's a great fact, which I love. Data centers today need to run 99.99999% of the time. That means they can be down 3 seconds a year. You're not going to use solar and wind, which work 20 to 40% of the time for that. And nuclear certainly will play a role, but it takes a long time to build a nuclear facility. And these data centers want power now. So this is an article in today's Wall Street Journal, and I just grabbed this chart here to share with you because I think that's sort of so powerful. The other area of demand growth for gas is LNG exports, and we're going to increase, probably we're going to double our export capacity for LNG out of the United States. These LNG export terminals take 3 to 5 years to build, so there's pretty good visibility about what's going to be done, and they don't get built without a substantial percentage of their capacity pre-sold. LNG export terminals have some of the longest term contracts in the business, some of the highest visibility in terms of cash flows. And so we know they're going to be using more natural gas in the future. And so you've got these twin areas of gas demand, and that hasn't changed. And so the sector's been disappointing this year. Performance has been flat to negative. Some of the LNG names have been hit pretty hard. And that's just really made it a better opportunity, in our opinion. And we're certainly finding that story has resonated with some of our long-term clients. Enterprise value to EBITDA is a metric that industry likes to use. I know Henry doesn't always think it's the best measure, but for what it's worth, Wells Fargo produces this chart, and you can see that EV to EBITDA has drifted down from 11 times at the end of last year, fourth quarter of last year, to 10.1 times now. So what's happened this year is that operating performance for midstream companies has continued to improve, cash flows have continued to grow, and the stocks have moved sideways and in some cases gone down. And so they've just gotten cheaper. It's just become a better investment opportunity than it was at the end of last year. And so that's why people should be looking at adding to their allocations to this sector, or if you're not in, here's your opportunity to get in, because the fundamentals that are driving cash flows and demand for midstream energy infrastructure are absolutely still there. Data centers with the AI revolution, LNG exports, and our business is biased towards that story and towards natural gas. The good news is that for people adding money to the sector today, it's not that you're chasing a bubble. Quite the contrary. I mean, if you look at that, flows this year have been somewhat positive. The last month was a little negative, but there's no sort of, as we say, fear of missing out. There's no FOMO here. We've had 6 years. If you look on the left chart, actually, so we've had 7 consecutive years of net outflows from this sector. Investors are cautious about energy, and I think, people ask me why that is, and I think if you talk to somebody about the energy sector who's not involved in it, all day long like we are, probably the first thing to think about is price of crude oil. And crude oil's been soft, and there's a lot of forecasts that crude oil's going to continue to trade down. And so the first thing people think of is, okay, oil's weak, so therefore the energy sector must be weak. And midstream is different. And we showed last year there's really no meaningful correlation between midstream energy infrastructure and commodity prices. Oil was down, we were up a lot. So sentiment is cautious at best. The operating fundamentals are improving, and the 2 big drivers of demand are absolutely there as much as before. And that's why we are, we're doing a lot of calls with people, and I'm seeing a lot of big clients on this trip I'm doing across the Southeast, which is about a 10-day trip. And we're telling that story to everybody that we talk to. And you know what? People have been invested with us for a long time. It's really sort of resonating with them. Here's a P ratios for selected names. We own all of these names in various size. And as you can see, the average of 18 there is well below, the S&P 500. So this sector is cheap also based on that sort of conventional measure of where valuations are. And I put this chart up on the blog. I imagine a lot of people on this call read the blog. And, the last few months have sucked for some of these names. I mean, Next Decade got to final investment decision on Train 4 on their Rio Grande export terminal. Revised down EBITDA guidance just a little bit. Stock got hit pretty hard. Venture Global, way below its IPO. It IPO'd at $25 in January. We didn't really get involved until really quite recently. They lost an arbitration case, which Henry's going to speak to in more detail. That's one of the 2 biggest LNG exporters. They compete with Cheniere to be the biggest, depending on the year that you're looking at. Energy Transfer is another one that's really well positioned to provide gas to data centers. They're in Texas. There's a lot of new demand from data centers for what's called behind the meter power solutions, which essentially bypass the existing grid and set up a direct feed of gas to a turbine or power station right next to the data center. Energy Transfer is well situated for that, and all within Texas, which is one of the easier places to do energy construction, a very energy-friendly area. So I think that these are showing that there's just a little bit of misunderstanding. Venture Global went down for good reason because they lost an arbitration case, although I think the market has way overdone how much it should have gone down. But broadly speaking, there's a really good opportunity here, I think, to get into the sector. And so this will have at the end here ways to get in touch with us. I'll just hop back to that chart. So I wanted to switch at this point to my partner, Henry, and Henry's going to talk a little bit more detail about some of these selected names and why we think they're cheap and the outlook. And after that, we're going to take questions, and I think we should be done with 30 minutes from the start. So Henry, let me hand it over to you.
Yes, thanks, Simon. So we follow the sector, every day, and have been doing this for a very long time. And so one of the things you start to notice is that the sector for a very long period, it trades usually pretty highly correlated on a day-to-day basis amongst the names. You know, one of the things that we used to always find almost odd in a way, but makes sense when you see it long enough, is a company like Plains All American that's all oil, and at Williams companies would move, same direction each day and similar movements. And so a lot of this is the names are all in the XLE, and they may be affected by oil sentiment or generally as a yield play or whatnot. But you found, a lot of kind of correlation among the names in the very short term. They would deviate in performance over time, based on their specific businesses and fundamentals and sentiment around them. But this year, and really beginning last year, what we've seen is this large bifurcation in the market among midstream names. And so, we try to understand this, and I think a lot of that we come to understand as thematic. You've either been, what we see is you've been bucketed as one of these kind of AI feeding power demand for data centers name, and you trade that way, and have traded that way last year, and in particular this year. And so to us, it's very interesting because you've seen names like One Oak trade off 30% this year. You have Targa, it's off 15% or maybe a little more. Energy Transfer, a very large diversified investment grade company as well, off double digits this year as well. And as Simon mentioned, it's one of it might have the most exposure to data center growth in the market. If you're kind of following this from a bottoms up perspective. And yet on the other end, you have sort of these all natural gas. If you're just kind of solely natural gas pipeline, the DT Midstreams or TC Energy, which are both up around 15% this year, or the pure play natural gas pipeline company, Williams, which is up 20%. And so you look into, why is Energy Transfer down double digits and Williams up double digits, when if you look at the data center demand here, Energy Transfer system really overlays it in Texas. They have this incredible interstate system in Texas and in Oklahoma, fed by a GMP system. With almost 50% of their cash flows, in this kind of natural gas exposure. And so I think we find that particularly interesting this year. And it's a trend that's gone on a little bit. So now today we sit here and, Williams, fantastic high quality company, has a 6% DCF, a little over 6% DCF yield, we call it distributable cash flow. And Energy Transfer has a 16% distributable cash flow yield. And so that we think is sort of amazing in the market, how thematic this market has got. When we look back, just given the amount of cash flow Energy Transfer generates over time and their footprint, we'd expect them to have a lot more exposure to data centers and really the behind the meter natural gas hookups that are expected to kind of feed this amazing boom. So that's one of the things. So we found this interesting thing. You saw it in April with the tariffs, that if you have this NGL exposure, which we export a lot of NGLs, we in the global market, the U.S. is 50% of the whole global market for NGLs or LPGs, how you want to describe it. And so the companies that were involved in that got hit pretty hard. Targa, One Oak, Energy Transfer. With the oil price, oil price is down to 60. It shouldn't affect the cash flows of these businesses much, but they've been lumped into. You have Permian exposure, you have Balkan exposure, and they've traded off. They've been lumped in that bucket of lower oil prices will lead to fewer rigs and then less production growth. I think when we look through it, you see Targa announcing additional processing plants, right? An additional NGL pipeline out of the Permian in order to meet the growing demand. And if you look at the Targa story in particular, you have when Grand Prix came online, that's when the story really changed in 2019. The market didn't catch up till later, but that vertical integration, and here you come with Speedway to kind of 2.0, following 5 years of return on incremental invested capital of 20% plus at Targa. It's we think one of the best positioned companies out there, and yet it's been punished this year. So that's one of the things we're focused on. We're probably a little early about how we view that and kind of the shifting sentiment of these names, but we certainly think that this market has a lot of opportunity in it. You have huge differences in valuations with very similar underlying stories and very bullish long-term stories. Natural gas liquid demand worldwide is expected to grow, a quarter of the global market in the next 15 years. So we think that's a very positive story. And then on the LNG side, you've had this kind of pent-up demand from the DOE not giving their non-FTA licenses, which it really held up a lot of projects moving forward. Now that they've been granted, they're moving forward quickly, and so you kind of have this growing supply in the market, and so you've had these concerns in the market that supply is going to outstrip demand temporarily, and then you've seen a lot of weakness in the LNG names due to that. So I think I think if you step back and look at it, you have this very large large demand growth coming to the market. Shell has an incredible slide where they were forecasting it in just 2023 to where they forecast it today. Some think demand will outstrip supply shortly after this, but you get these things in the market where, okay, we might have a temporarily LNG supply glut with these U.S. capacity coming online, and therefore these LNG names have sold pretty hard, despite their very long dated, very solid contracts where you sell out a lot of your capacity at 20 years. So incredibly visible cash flows for a very long time from very high credit worthy counterparties. And so again, we think that's one of the best stories in the market, but temporarily it's been dropped in this thematic bucket of, okay, we might see lower global prices, which who knows for a few years as these projects come online. So I think it's something we're looking at in the market, and we think it really presents kind of this incredible opportunity.
Yeah, that's great. So let me just go and emphasize a couple of these slides that we got. So this one here, and everybody should read the Wall Street Journal article. It's on the front, it's front and center of their website this morning. But just to give you a couple of facts that they have now, in Texas, they expect their peak power demand to be 62% higher by 2030 in 5 years' time. The peak electricity will be 62% higher in 5 years. Data centers across the country in 2020 were 2% of US power consumption. They're now expected, according to the US Department of Energy, to be 12%. So they're going to increase their share of US power consumption by sixfold in 3 years by 2028. So they're going from 2% to 12% from 2020 to 2028. In Oklahoma, which has a lot of gas, the governor of Oklahoma is promoting the state for gas use to power data centers, particularly for behind the meter, where they just deal directly with the gas supply. So this story hasn't changed. And if anything, as we go through time and we all see the tens of billions, hundreds of billions of dollars being dedicated towards data centers, it just becomes more and more firmed up. And then on the valuations, 11 times EV to EBITDA is the 10-year average for the sector. I mean, I don't know why it's not trading above that average, never mind at a discount to that, given everything that we see that's happening, and most especially on the gas side. Oil could be a little bit different, but as everybody knows on the call, I'm sure we're biased towards the gas side. So I just wanted to share those. So now we've been getting some questions that are coming in, and I'm going to start to answer a couple of those here. In fact, Henry, I'm going to ask you to answer this one. The trade tensions with China are stepping up, particularly with the rare earths. What do we think, if anything, could be the impact on this sector of increased or perhaps aggravated trade tensions with China?
Yes. So one of the wonderful things about this sector is it's all North American infrastructure and mostly American infrastructure. Where we participate more in the global market is exports, primarily in our sector. That's exports of on a cash flow basis of NGLs and LNG. Sort of the way that these contracts are written they're very long dated contracts for LNG. They're take or pay in extremely large part, in which you're paid a fee for your capacity. So you get paid really for the option of refrigerating that gas. So you're going to get paid whether people show up ships. If you have a contract with a Chinese buyer, whether they bring a ship or not, you still get paid your towing fee and the same margin as if they brought a ship and you filled it up. And then you can just sell those cargoes elsewhere. On the NGL side, it's largely fee-based for dock space. In the same manner of when you build this infrastructure, you have the contracts in place. They're not as long on the NGL side as they are on the LNG side. But again, the trade disputes with China, I think the market gets very nervous. The U.S. is the only one that sends liquefied ethane by ship around the world, and China buys about 50% of that. They buy it because they need it to run their polyethylene facilities, and that's why it ends up there. A lot of the ones we actually contract with are global traders and major trading houses, so you have very little exposure directly to China based on that. So the results on cash flows are fundamentally, it's very little, even though it seems to get a lot of press in the macro news of China's pulling back from buying US LNG or going to tariff US LNG, or China's going to pull back from buying these NGLs. So in the short term, I think that it creates choppiness in the market. Longer term, China has enormous energy demand, so they need everything, right? And they have a huge demand for natural gas. So you'd expect them to be increasing buyers of LNG and driving that market. I think so. I think there's a very good story there. The same way with NGLs feed the petrochemical sector, which is the building block of all materials. And as these places get wealthier over time, that demand is going to increase. And so all forecasts are for petrochemical demand to rise at 2 times the rate of global GDP.
Yeah, I
think that's a very strong story there.
And Henry, you've often made the point, NGLs, natural gas liquids, are sort of the unsung heroes here, because we all focus on natural gas, which is methane, and that's used for power generation and so on. But natural gas liquids, which include things like propane, and we're the world's biggest exporter of propane. Propane's used in your gas barbecue, it's used in agriculture a lot for crop drying, and it's used in the petrochemical industry in China. So we have a real big edge there as well. And macro issues have certainly been front and center, I think, in the last few months. I got another question here on macro about Russia. What would be the impact if, for example, Russian gas, which has been, volumes of Russian gas exports have dropped dramatically because of the war with Ukraine, and they've been scrambling to try and export more of it as LNG. What would be the impact on the global gas market if we gradually saw more Russian gas come into the supply mix?
Yes, and that's certainly a concern, right? You saw LNG names, U.S. LNG names trade off pretty hard leading up to the summit in Alaska between Trump and Putin. So, it's a macro trade. But again, these Cheniere being the largest one, they're 95% contracted to 2030, 90% contracted out to 2035. The LNG demand is growing, nicely worldwide. I don't see Europe going back to piped Russian gas. I think that would be, pretty crazy, given 2022 and their kind of dependence there on their strategy. And you're seeing Europe move away to a more sensible, realistic strategy. I think Europe has seen their manufacturing base deteriorate, and they don't want to continue losing industry. So they're pivoting to reliable partners and reliable sources. And then again, same as the U.S. story. The U.S. is way in front of everyone else on data centers. The U.S. has a little over 500 data centers currently and has announced plans for 500 more. Now, not all those will get built, at least in the next 5 years or so, but a lot will. And the way we see it is the rest of the world should kind of follow suit behind the U.S. They might be a couple years behind us, but everyone's going to want their data centers within their own borders for security reasons. And so there's no reason that shouldn't replicate what's happened in the US, which is data centers are looking for reliable power. And the only way to really get that today, if you don't have excess capacity at the utility level, is via natural gas. Nuclear takes many years. Renewables are unreliable. The Western world doesn't want to go back on coal. China's already building as much coal as possible. And it's kind of cost competitive versus natural gas prices. So Russia, that gas will continue, I guess, to move east. But I think the more likely scenario is Europe cracks down as they have announced that they'll cut out buying Russian LNG, and it'll go in the other direction, creating more dependency on the U.S.
Now, here's a capex question, right? So you've got this interesting sort of dichotomy in the sector, because upstream oil companies in the US are reducing capex, they're reducing their planned investment in new production, but midstream companies, especially gas, are increasing capex, and you're seeing that to a very large degree across Texas and the Southeast, and then a little bit lesser degree up in the Northeast and Marcellus Shale. Now, 10 years ago, the industry increased capex because of the shale revolution, and not all of that money was well invested, and of course then the sector went into a swoon. So this question is, how should investors feel about the increased capex on the natural gas infrastructure side? Is there any chance it'll put pressure on cash flows, perhaps impede distribution growth? How should we think about that, Henry?
Yeah, I think this time around is a little different. Last time the stranded capacity argument was around mostly oil, where oil prices decline, which are much more global. Natural gas prices are more local, but becoming increasingly global with the larger LNG trade. But the U.S. has an abundance of natural gas that is highly economic. So you can bring on the amount of gas that you need, I think, to meet increasing power demand, industrial demand, heavy industry demand, and so I think that's pretty good. Natural gas is much more of a demand pull story as well, which means before you build a natural gas line to utility, you'll often have a 15 to 20 year contract that rents capacity, whether gas flows or not. These behind the meter deals you're seeing with the data centers are 10 years. And it looks like from the deals that have been announced so far, they're building them at about 5 times EBITDA. So that's, even though it's less duration there, the trend is very strong, I think, going forward. You're building them at great multiples. And probably the best part of it is these are short laterals in, which you don't get hung up in the permitting process the same way you do for very long linear infrastructure projects. So you get good returns, creditworthy counterparties. You're acting as gas pool on that demand with rented capacity. And then I think most importantly, you have a shorter CapEx cycle where you can recycle your capital in the 18 months it takes to put a data center online. So you don't have these, multi-year projects that can delay on and on. You have high visibility into when the project will be completed and what the returns will be. And I expect these relationships will build out with customers. And so in that environment, it is, I think it's very strong. It doesn't seem to be very competitive. They want large companies that make sure that they can deliver the power and deliver the fuel. So I think investors will reward it in the end.
So now, that's great. Now, I think this is a great question related to that on AI, and I think this can be the last question, so we wrap it all up at 11:30 Eastern. AI energy demand is predicated on continuing capex in an industry with no returns to date. How do we assess the risk of that demand not materializing as projected? So what if, not all of these data centers that are expected get built, the bubble bursts? How does that affect us?
So you build it 5 times EBITDA with a 10-year contract, you're not losing money. So in these large, when you're spending billions of dollars, a gigawatt of power from the natural gas side is about a $5 billion infrastructure project. So when you're spending this money up front, you have contracts in hand, who's going to foot that bill longer term would be the hyperscalers, or I don't know, I'm not too into how the data center actual contracts are, but if you own the data centers, I think that's a bigger risk there. When you're providing the fuel, you're lining up these contracts in advance to mitigate that risk. Everything seems as though it's going to continue. The data center growth is going to continue. But yeah, if that happens, it's, you may not see that continued growth and CapEx outlay, but these companies are not doing anything on spec.
Right, there's no field of dreams in this area, right? They're building when they've got long-term contracts set up. So yeah, that's a great answer.
Yeah,
well,
yeah,
look,
they weren't 10 years ago there.
We're going to wrap it up here. It's 30 minutes. It's, there's so many people I see on the list of attendees, which is just fantastic. Lovely to see all of you signing up and chatting. We do a lot of calls with clients. We're here anytime any of you have questions, pick up the phone, call us, send an email. We work really hard to communicate with all of you. We appreciate everybody's support. We do think this is a great opportunity. The fundamentals are just as positive as before. And thank you everybody for your interest. Great to see all the names there on the attendee list. And I'm sure I'll be speaking to a lot of you in the weeks and months ahead. So take care, everybody.